Meet two people you will never see in the same room. The first is named Ray. He is 66 years old. Last Friday, he walked out of an office he had walked into for 31 years, shook a few hands, ate a slightly dry piece of cake, and became officially retired. He has $750,000 saved. He feels, for the first time in decades, calm. The second is named Dana. She is 29. She has a job she mostly likes, a savings account she is very proud of, and a plan. The plan is simple. She is going to wait. She is going to keep her money safe and dry, and the moment the market crashes, really crashes, she is going to pour everything in at the bottom and get rich on the rebound. She feels, for the first time in her adult life, like she has it figured out. Now here's the strange part. The exact same event is about to hit both of them. A market shock, a drop, the kind of ugly gut-punch decline that shows up on the news with red arrows and grim music. One event, two people, opposite ends of the same road. And it is going to hurt them both. Ray, because the crash arrives at the worst possible moment for someone who just started spending. Dana, because the crash she has been waiting for either does not arrive on schedule or does arrive and she still manages to miss it. Two lives, same shock, same lesson. You cannot time the hit, so you have to build something that survives it anyway. Welcome back to Modern Wealth. I am Neo. Today we are talking about the one piece of financial engineering almost nobody thinks about until the road gets rough. The part that absorbs the shock so the rest of your life does not have to. Let us get into it. Let us start with the thing everybody quietly believes and almost nobody says out loud. Deep down, you think you will see it coming. Not perfectly. You aren't arrogant about it. But you figure that when the big one arrives, there will be signs, a feeling, a headline, something in your gut that says, now get out, or now get in. You will read the moment correctly because you've been paying attention. I want to be gentle here because I've believed this too. It is not true. Market shocks are not weather. Weather you can forecast. You look at the sky, you check the radar, you grab an umbrella. Market shocks are more like a pothole on a dark road at high speed. By the time you feel it, you are already in it. The information that would have let you swerve does not exist until after the swerve was needed.
Think about the actual crashes of the last 20 years. A housing collapse that most experts swore was contained right up until it was not. A global pandemic that wiped a third off the market in about a month. And then, while the news was still terrifying, quietly turned around and ran to new highs. Nobody rang a bell. There was no announcement. There is never an announcement. And the recoveries are just as sneaky as the crashes. The single best days in the market have a rude habit of showing up within a week or two of the worst days, right in the middle of the panic, right when every instinct in your body is screaming at you to stay out. So when I say a shock is untimeable, I do not mean it is hard. Hard implies that with enough effort you could crack it. I mean the timing itself is not available, not to you, not to me, not to the confident man on television with the nice suit and the laser pointer. Which changes the entire question. If you cannot know when the shock hits, then the goal was never to dodge it. The goal is to build a financial life that keeps working whether the shock comes today, in 10 years, or 5 minutes after you retire. That is the whole game. Let me show you both ways people lose it. Back to Ray. $750,000, fully retired. And here's the thing about Ray that makes him feel safe. He did everything right. He saved for decades, he invested in the market, he earned solid, respectable long-term returns. On paper, his plan works beautifully. On paper. Because there is a monster that lives specifically in the first few years of retirement, and it has a boring name that hides how dangerous it is. It is called sequence of returns risk. Here's what it means in plain language. When you are saving, the order of your good years and bad years barely matters. A crash early, a crash late, A boom in between, it all mostly washes out because you are not touching the money, you are adding to it. A downturn is even a gift, you are buying cheap. But the day you stop adding and start withdrawing, the order suddenly matters enormously. Watch what happens to Ray. Ray retires, and the market drops hard in his very first year. Not a gentle dip, a real one. And Ray, because he needs to eat and pay his mortgage and live his life, has to sell some of his investments to cover his spending. He is not selling because he is scared. He is selling because it's Tuesday and the bills are due.
But look at what he is forced to do. He is selling shares while they are down. He is locking in the loss. And every share he sells at the bottom is a share that will never be there to recover when the market bounces back. He is spending his seed corn in the middle of the famine. Run that forward. Same average return over his retirement, same withdrawals. The only thing that changes is that the bad years land early instead of late, and Ray's $750,000 does not gently decline. It collapses to $213,000. Say that number again. He starts with $750,000. The bad timing alone, not bad choices, not bad luck spread out, just the wrong order of returns drags him to $213,000. Same investor, same portfolio, same average return, a completely different life. That is not a rounding error. That is the difference between a comfortable 30-year retirement and running out of money at 78 with a lot of road left. And here's the cruel twist. Ray could not have prevented this by being smarter about timing, because we already established that nobody can. The crash was going to come when it came. His mistake was not his forecast. His mistake was that he had nothing to absorb the hit. So let us talk about the part almost everybody skips. When people picture a strong portfolio, they picture growth. Stocks going up, the line climbing. And that's fine. That's the engine. That's what builds the wealth in the first place. But an engine is not the whole vehicle. Imagine driving a car that is all engine and no suspension. Every crack in the road, every pothole, comes straight up through the frame and into your spine. Fast, sure. Powerful, sure. Unbearable the moment the road gets rough. Bonds are the suspension. They are not there to make Ray rich. That's not their job. And if you judge them as a growth engine, you will always be disappointed, and you will always sell them at the wrong time. Their job to be the calm, boring, dependable money that Ray can spend from when stocks are down, so that he doesn't have to sell his stocks at the bottom. Picture it. The market drops. Ray needs cash for the year. Instead of selling shares into the crash, he reaches into the bond side. He spends from there. He lets his stocks sit, wounded but untouched, and gives them the time they need to heal. When the market recovers, and it always eventually has, his shares are still there to ride the wave up. The bonds took the punch, so the stocks did not have to. That is the whole idea. That is the shock absorber, a defensive layer that exists for exactly one purpose: to keep a temporary drop from becoming a permanent loss. And here's what makes 2026 a genuinely interesting moment to say this out loud. For years, this defensive layer paid you almost nothing. Bonds were safe and dull and roughly pointless as a source of income. People kept their safe money in a bank savings account, earning, and I am not exaggerating, somewhere between 1/100% and maybe 0.4%. Effectively zero. Your safety cost you everything in lost growth. That is not the world right now. Right now, treasuries, some of the safest instruments on the planet, are paying real money again. Shorter maturities around 3.75%, medium ones around 4.5%, longer ones north of 5%. Now hold that next to the bank's savings account paying you a rounding error above nothing. Your defensive money, the part of the portfolio whose whole job is just to sit there and be safe, can now sit there, be safe, and pay you 4 or 5% while it waits. Wait, let that land. For the first time in a long time, playing defense is not a tax, it is a paycheck. For Ray, that changes the math completely. His shock absorber is no longer dead weight. It is safety that pays rent. That is the withdrawal side. A shock hits at the worst moment, and the person with a suspension system rides it out, while the person with none gets rattled down to 213,000. Now let me flip the whole road around, because the exact same untimeable shock destroys people at the other end too, and this one is sneakier because it feels responsible. The accumulation side. Dana. Back to Dana. 29, smart, disciplined, and absolutely certain she has outsmarted everybody. Her plan, remember, is to wait, keep the powder dry, sit in cash, safe and patient, and strike when the market crashes. Buy the blood. Get rich on the rebound. And I have to be honest with you, this plan sounds incredible. It sounds like the smart money move. It sounds like exactly what a disciplined person would do while all the amateurs panic. There is only one problem. She is waiting for a starting gun that nobody is going to fire.
Because the crash she is waiting for is untimeable, remember? It does not send a text. So Dana waits. 6 months, a year, 2 years, and the market, ignoring her completely, does what it does most of the time, which is grind upward. New highs, then higher highs. And every single one of those higher highs makes Dana more certain that the drop is right around the corner. So she keeps waiting, and the entry point she was hoping for keeps floating further and further out of reach. She is not investing, she is spectating. And every year she spectates, she gives up the one thing she can never buy back: time in the market, compounding, the quiet, relentless snowball that only works if the snowball is actually rolling. Let me put real numbers on this, because a research team already ran the exact experiment. The Schwab study. Take a 20-year stretch. Give 4 different people the same amount to invest each year. Same money, same market. The only difference is timing behavior. And then just watch. Person 1 is a fantasy, a perfect timer. Every single year, this person somehow invests their money at the precise lowest point of the year, the absolute best day, 20 years in a row. This is not a strategy. This is magic. Nobody alive can do it. But we let them just to see the ceiling. Perfect timing 20 years turns into $186,000. Person 2 does something almost insulting in its simplicity. They take their money at the very start of each year, and they just invest it immediately. No thought, no timing, no waiting for a dip, money in hand, money in market, done. The do-nothing invested immediately person ends with $166,000. Now stop and look at that gap. The literal best market timer who has ever theoretically existed with flawless supernatural foresight beat the person who just shrugged and invested right away by $20,000 over 2 decades. $20,000. That is the entire reward for perfect timing versus doing the laziest possible thing. Which means the person who invested immediately captured roughly 90% of the benefit of perfect godlike timing by putting in exactly 0 effort and having exactly 0 skill. And now, person 4, Dana. Person 4 does what Dana does. They keep the money in cash, safe and waiting, holding out for the perfect crash to buy the dip. The cash waiter ends with $47,000. 47 against 186, against 166. The person trying hardest to be smart, waiting for the perfect moment, protecting their cash, finished with barely a quarter of what the person who did no thinking at all walked away with. Let that sink in. Trying to time the entry did not just cost Dana a little. It did not just underperform perfection. It got beaten into the dirt by a person whose entire strategy was, and I quote, invested and forget it. Waiting for the crash cost her more than any crash ever would have. The perfect foresight paradox. Now, I can hear the objection, because I had it too. You might be thinking, fine, but that study assumes the waiter never actually catches a crash. What if Dana is right? What if a real crash does come and she does buy the bottom? Then she wins, right? Then all the waiting pays off. This is the best question in the whole video, so let us answer it with the most ruthless test ever devised. A researcher named Nick Majuli ran the version of this that should settle the argument forever. He looked across 40 years of market history and set up a contest that is almost unfair. On one side, ordinary, steady investing, just putting money in on a regular schedule, month after month, ignoring everything. Boring, automatic. On the other side, a strategy with a genuine superpower. This investor gets to save up their cash and buy in only at market bottoms, and not approximate bottoms, perfect ones. This version of the buyer has perfect foresight, God vision. They know in advance exactly where every bottom is and get to deploy their saved up cash right there, every time. So, steady, mindless, automatic investing versus a person who can literally see the future and buys every dip at its exact lowest point. Surely the fortune teller wins. It is not even a fair fight. The fortune teller loses. Across those 40 years, the perfect foresight bottom buyer still lost to plain, boring automatic investing about 70% of the time. Read that again slowly. Even with perfect knowledge of every market bottom, waiting to buy the dip loses to just steadily investing 7 times out of 10.
How is that possible? For the same reason it broke Dana. While the fortune teller sits on their cash waiting for the next perfect bottom, that cash is out of the market. And the market, most of the time, is going up. All those months of waiting for the perfect moment mean months of missed growth. The dips they eventually catch are still, on average, at prices higher than where the steady investor was already buying years earlier. The wait costs more than the discount saves, even when the discount is flawless. And now, the part that should end this debate permanently. Maguli then asked, okay, but that assumed perfect timing. What happens if our fortune teller is just a tiny bit off? What if they missed the exact bottom by, say, 2 months? Not 2 years, 2 months. A rounding error in a 40-year lifetime. The win rate for the dip buyer collapses to 3%. 3. So let me lay the whole thing out for you, because it is almost funny. If you have literally perfect knowledge of the future, waiting to buy the dip still loses 70% of the time. And if you are off by a measly 2 months, you lose 97% of the time. That is the trap Dana walked into with her eyes open, feeling clever the entire way. Waiting was never the safe, smart, patient move, it felt like. It was the losing move dressed up in a nice suit. So let us stand back and look at what we have. 2 people, opposite ends of the road. Ray, at the end, gets wrecked by a shock that comes too early and forces him to sell into weakness. Dana, at the beginning, gets wrecked by a shock she waits for, mistimes or misses entirely, and the waiting itself bleeds her dry. And now watch what they have in common, because this is the whole point of everything. Both of them made the same underlying bet. Both of them, without ever quite saying it, bet that they could position their money around the timing of a shock. Ray assumed the good years would show up when he needed them. Dana assumed she would recognize the bad year and pounce. Both were trying in their own way to be in the right place at the right time. And the shock does not care where you stand. That is the lesson the whole road teaches. The shock is untimeable. So any plan that depends on you being in the right spot when it hits is a plan built on a coin flip you have quietly decided you will win. Here is the reframe. The thing that saves Ray and the thing that saves Dana are the same thing wearing 2 different coats. The thing that saves Ray is a shock absorber on the withdrawal side, a defensive layer, those bonds paying real money now, that he can spend from so he never has to sell his stocks at the bottom. The structure absorbs the hit. His timing no longer has to be right because he built something that works even when the timing is wrong. The thing that saves Dana is a shock absorber on the accumulation side, and her shock absorber has a name too. It is automatic, steady investing. Money in on a schedule. No waiting, no forecasting, no clever pouncing. Some of that money will inevitably go in right before a drop. That is not a bug. That is the suspension doing its job, spreading her entry across the good days and the bad days so that no single moment can make or break her.
She stops needing to catch the bottom because she has built something that works even when she has no idea where the bottom is. Same fix. A structure sturdy enough that timing stops mattering. Ray does not predict the crash. He is padded against it. Dana does not predict the recovery. She is already in the market to catch it. Neither of them ever has to be right about when. And that, right there, is what wealth engineering actually is. Not a crystal ball, a machine that keeps running no matter what day it is. So let me talk to you directly for a second, because I know what this can feel like. It can feel like I just took away your steering wheel. Like I said, you cannot time the market, you cannot see the crash, you cannot outsmart it, so give up, close your eyes, and hope. That is the opposite of what I'm telling you. I'm telling you that you have been pouring your energy into the one thing you are never going to win, the timing, and you have been ignoring the one thing you can completely control, the structure. You do not get to decide when the shot comes. You never did. Ray did not, Dana did not, nobody in that study did. Nobody on television does either, no matter how confident they sound. But you get to decide what your money is sitting inside of when it arrives, and that decision is entirely gloriously yours. You can build the withdrawal-side cushion so that a bad first year of retirement is an inconvenience instead of a catastrophe. And in 2026, for the first time in ages, that cushion actually pays you to hold it. Safety with a yield instead of safety with a cost.
You can build the accumulation-side habit, the automatic, boring, unglamorous act of investing on a schedule and letting compounding do the quiet work. So you are already on board when the rebound comes, and you never spend another year frozen on the sidelines waiting for a bell that does not ring. Neither of these takes genius. That is the best part. They take a decision and a little bit of setup, and then they run on their own. The whole point of a good structure is that it protects you even on the days you are not thinking about it, especially on those days. So here is where I want to leave you. Stop asking when. When is the market going to drop? When should I get out? When is the perfect moment to jump in? That question has been quietly robbing careful, intelligent people for as long as markets have existed, and it will keep doing it because it has no answer. Ask a better question. What am I built to survive? Build the thing that does not need you to be right about timing. Put a cushion under your withdrawals. Put your investing on autopilot, and then let the shot come whenever it wants, because you will have already made it something you can absorb instead of something that breaks you. You cannot smooth the road. Nobody can. You can absolutely build the thing that soaks up the bumps. I am Neo. This has been Modern Wealth. Go build your suspension before you need it, and I will see you in the next one.